Hello, hello, hello. Welcome to this Lunch and Learn. And as you know, it's a short TED Talks just to keep us on track with our knowledge and our learnings. And so one of the things that we've decided to discuss today is new developments versus existing property. It's a question that, over my last 20 years is something that comes up a lot in terms of what people look for and how they actually do it. So just to remind you, what is the Wealth Hackers all about? Well, I believe very strongly in trying to put myself in the room where I'm the dumbest, poorest person, because then I can only go up. And when I went to spend a week with Richard Branson on Necker Island, I've had the privilege of doing 2 weeks with him actually, was we had to come with a life hack. And the whole idea with the life hack was how could you get there quicker, simpler, safer? And so I tend to refer to myself as a wealth hacker. I'm hacking my way to wealth, and we're all wealth hackers at the end of the day in terms of that process. What we're sharing with you is not financial advice. It's just our experience. And I did my first property project when I was 13, my first development when I was 22, my first London property when I was 24, and I've helped thousands of people buy houses in South Africa and apartments in South Africa, hundreds in the UK, hundreds in Australia, and hundreds in America. And so a lot of experience around what works and what doesn't work in terms of houses versus new developments, et cetera, existing property versus new developments. So I can see in the chat box there, let me just open up the chat box so that I can monitor that as well. Hello, Peter, how are you doing? Cool. So this is a quick recap. You would have seen this, you should have seen this elsewhere in terms of the real estate value chain. The old system is currently broken. You and I as investors are sitting here. We want to invest in a house and an apartment. There's 16 different middlemen on average between our investment and us as the investor. There's no trust, there's no transparency. And because of all the high fees and low returns, there's a lack of alignment. In terms of the value chain of real estate, you basically go from land zoning to the developer, to the investor, to a fund or a REIT, and then to you and I. And the type of returns that they're looking for are the land developers looking for an internal rate of return of roughly 30%. A developer is looking for 25%, and an investor is looking for roughly 20%. Now, it doesn't necessarily mean you get that, but that's a target return. A fund or a REIT is looking for a cash flow. Oh, apologies. A cash flow or an income of 5 to 8%. And then you and I are trying to kind of beat inflation, which is kind of where we come behind. And, what's interesting is that if you want to look at there's some LinkedIn articles, go on my LinkedIn profile, go and read about how wealth is created in real estate. You can literally read all about it. I'll post it during the FAQ in terms of the process. So the question I always ask people, well, if you realize that all the money is being made at a fund or a REIT stage between the investor and the fund or the REIT, and you and I are at the end of the value chain, why don't we go up the value chain? Why don't we invest as an investor? Why don't we get involved in commercial property? Or why don't we actually do the development ourselves? And having done this for over 20 years, there's a myriad of excuses that people have. I don't have the time, I don't have the knowledge, I don't have the know-how, I don't know where to get started, et cetera, et cetera, et cetera. And so using technology, we basically have made it easy for people where you can now cut out the middleman. I tend to use the analogy of a cell phone. Before we had, a cell phone or a smartphone, we didn't have Uber. And so we all had to phone a taxi owners association, who then phoned a taxi driver who finally came to pick you up, generally probably an hour or two late. If you didn't know where you're going, they'd take you the wrong way. There was no trust, there was no transparency, and it was very expensive. What technology does is it cuts out the middleman, it cuts the costs, and it dramatically increases the trust, the transparency, and the accessibility. So our belief is that you can go up this value ladder. Now, if you want to look at the risks, if you take a growth opportunity or what we call a new development, it tends to offer a higher return, okay? So if you take the value chain again, it's higher up the value chain. So it offers a higher return. And the reason being is that there's more risk involved in the deal. The challenge is that you only get a return at the back end. So there's no income while the development is being built. And you effectively only get the return on the back end. The other thing that is a challenge in terms of the opportunities is that there's a lot of risk that is even out of the developer's hands. So there's development risk, there's execution risk, sometimes there's political risk, there's economic risk, and a lot of things that people don't and can't necessarily take into account. So projects can take longer, construction costs can go up, interest rates can go up. There's a lot of unforeseen things. And so because of those risks, that's why developers tend to want to look for a return of 25% plus. You know, the sales might not happen as quickly as they want, or the leasing up might not happen as quickly as they want. And because of the long times, it has an impact in terms of, you know, the feasibility. So you know, a good example was we had a new development in Australia, and sorry about that. I consider myself Eskom proofed, and I don't quite know what's going on today. My battery, well, Eskom keeps coming on and off, and it's doing something weird with my battery. So apologies about that. So let's go back to sharing my screen. I'm now going off my cell phone. So I was telling you the story about our opportunity in Australia. And what I think is important basically is that, you know, we had a development, we had pre-sold the amount of units you needed to have the pre-construction finance. They'd been sold in Hong Kong and China specifically. And then Australia changed the rules. Sorry, not Australia. China changed the rules to capital flows coming out of China. That had a big impact on the Australian market almost overnight. The banks then changed the rules against lending to overseas people, which immediately made all the pre-sales fall out of bed. And then almost overnight, the construction finance that was already approved got pulled. So we owned a piece of land with the pre-sales in place, with the construction financing in place, and it all fell apart. And that's what I mean by risks that can be out of your control. I mean, you can do all the due diligence you want in the world. You can't foresee what the Chinese government is going to do or not do in terms of that project. And we've had to stay with that project. We've now changed it into co-living. We've turned the entire project around. We've got new zoning, new planning, and everything in between. So the investors won't lose money, but it's a classic example of timing risk that they can lose. In terms of the income opportunity, it's different because you're dealing with an existing building. So the variables are a lot less. You're dealing with existing opportunities, whether it's a house or apartment or a commercial building, and you basically can rely on what is the numbers that you're given, because the numbers are actuals. You've got an actual building with an actual tenant with an actual return. And so you've got a much better idea of what it is that you actually are getting in terms of return. Now, the downside of that is that because the risk is stabilized, you've taken value off the value ladder. So that's why I started off with the value ladder. And if I just go back a couple of slides, because I think it's important, is that if you take this value ladder, you can see that, you know, you've got land zoning. We don't go here because this is just too risky, full stop. And it can take years to get land zoning, you know, somewhere between 3 to 10 years often. Then you've got the developer, and then you've got the investor. So just remember, we started with the developer. So it's higher risk, higher return. And then you've got the investor, which is lower risk, but obviously the return is taken into account with regards to that. So if I go back to the income opportunity, what you're looking at, there are still risks. There's always risks in all investments. And what is important is that there's a capital call risk. So if you've got a mortgage with a bank and you need to be able to pay the mortgage every month or every quarter, you've got to make sure the income's there. So, you've got to make sure that the tenants can pay the rent. And one of the things that's important there is to look for multi-tenancy. Okay. The second thing you've got to be careful of is interest rates rising. So it's very important to try and fix your interest rates. The third one is valuation risk. How do you make sure that if you're buying the building and it's worth 100, that it's actually worth 100, it's not worth 70 or 80. And so, these things become really, really important in terms of managing risk. And just to give you an example of how we do it, on the tenant risk side, we look for multiple tenancies, and we also look for long-term leases. On the interest rate side, we like to fix our interest rates. So have our partners on the ground actually fix our interest rates. So we're not at the political mercy we're not at the mercy of politics and economics. And then valuation risk is really important because it's managed in three different ways. The one is that you've got replacement value. So how much does it cost to, build this property, and am I buying the property at a discount based on replacement cost? Secondly, you've got the partner on the ground that's actually putting their money into the deal. So they're saying it's worth 100, and they're actually putting their own money into the deal, which becomes really, really important. And then thirdly, there's bank debt on it, and the bank is making sure that they've got their their valuations, etc. Now, do they always get it right? No, they don't. But that's why you've got three levels of risk mitigation in terms of that process. Depending on what country you invest in, you've got political risk. Some would say that China, India, South Africa has a lot more political risk. Maybe not. But I mean, we had Brexit, which caused properties to go down by 20% in London, as an example. So it does happen, in America. Obviously, the last crash in 2008, 2009, residential property lost anywhere from 40 to 70%, depending on what city you were talking about. So economic conditions could change. And it's another reason why I believe so strongly that you've got to diversify across countries, currencies, assets, and partners, because some markets go up and some markets go down. The last thing that I wanted to share with you was a story of a gentleman called Chad. And Chad bought a new development off us in Australia in 2011. Now, when you invest in Australia, you can only invest in new projects. You're not allowed to invest in existing houses. So there's no debate whether it should be a new development or an existing house. Secondly, we went to a very good area. It was right on the river, right next to, in Brisbane, right next to Suncorp Stadium, which is right on the verge of the heart of the CBD. It was with an established developer. And what was shocking to me was that he bought these properties, and we just did a valuation 10 years later, and the properties are on or below the same value that he bought it from the developer for. Now, we've had a couple of meetings with the developers, and we're like, what's this all about? And there's different reasons, short-term letting, et cetera. But from my experience, and I've helped thousands of people invest in new developments, and I've also, bought new developments myself, and I've also bought houses. So the age-old story that you get given with a new development is, don't worry, put down, a deposit of say 10, and if the property goes up by, sorry, I just want to get back my camera screen. If the property goes up by, 10%, then you've actually doubled your money. Okay, it's the whole principle of leverage. And so people say, well, I'll put down my 10% now. It's going to take 2 years to build the building. And then I might even pre-sell it prior to taking ownership. And the logic is I can double my money, I can triple my money. Unfortunately, the story makes sense. It made sense to me in the 2000s, but it doesn't work out like that from my experience. So, we then had the global crash in 2008, 2009. I had mortgages along with 33 other clients with Barclays Bank. Barclays Bank reneged on the mortgages. And suddenly we had 70, 80% financing in place. Suddenly we had no financing. And now we had to buy these properties in London outright, which was impossible. And now it was the whole threat of, do we lose the 10% deposit, et cetera. The other thing that happens is that on new developments, people are given rental guarantees. So they think they're getting a rental guarantee, but all that's actually happening is that the developer is putting, the price of the rental onto the contract, onto the purchase price. And after 2 years, all the properties are rented out. And so it's basically a race to the bottom, because suddenly you and the guy next to you wants to be able to, rent out the unit. the third thing for me that I found on new developments is that most of the meat is taken off the bone by the developer. So the developer makes huge profits. I've already shown you 25%. And you, the retail investor, it can often take more than 10 years for you to actually see true value. Okay, now, again, this is my experience, having done this thousands of times in 4 different markets: England, Australia, America, and South Africa. And so one's got to be very, very careful buying off plan, because from my experience, no matter which way you cut the cookie, the 10% story, double your money. Well, there's things like transfer fees and stuff now that stop that in most countries. You're not allowed to necessarily sell. There are still some, but places like Dubai will say, oh, you can do this and you can sell it early and all that. It's a myth. Like, real money is not made in that way. It's speculating. It's called buy to flip. And it just doesn't work, basically. And I've done this for 20 years and it just doesn't work. The second thing, as I said to you, is that the developer takes most of the meat off the bone. So we come along as the retail buyer and we buy a house or apartment, and it has quite a negative impact, particularly if we're all investors. And it brings me on to the third part, which is really important, is that Dolf de Roos said something to me many years ago, the author of Real Estate Riches, and he said, if you're buying a property, make sure that it's in a residential neighborhood. So make sure it's a place where people want to live and, take their kids to school and all that. If you're in an investor neighborhood where all the properties are owned by investors, it's not a good thing, because what happens is that the tenants don't look after the properties. All the landlords are competing with each other to try and rent out the property. And so it's a race to the bottom in terms of rentals. And I, again, I could tell you 50 stories of how I've seen this happen over and over and over again through the years. And it's a real problem. And, if I compare from my own experience, the properties that I bought that are existing properties, they have paid me a far better return. I've got no competition in the market because I'm generally in a residential area, versus owning one apartment in a block of 50, 100, 200 other, investors. Being in an investment section. The second thing is I'm buying from a motivated seller. And so I'm getting the price at a good value, whereas the developer is not a motivated seller. Like, they're selling it for the highest amount of money they can possibly convince the bank to sell it for. Now, don't get me wrong, sometimes you get lucky. Back in 2009, we got some great discounts off developers because the law is motivated sellers. And so my recommendation to you is we've got a thing called an e-wealth pack. Okay, I will share the e-wealth pack with you, and you can actually go and read the very first white paper, which is about the 5 laws to investing, and it talks about buying from a motivated seller, etc., etc. And so my final conclusion, and the idea is to keep this to a TED Talk length, is that there's lots of pros to existing property. If you're buying retail off a developer, there, in my opinion, are too many cons. It doesn't make sense to buy off a developer retail. And if you're wanting to go up the value chain, then it's better to partner with the developer and to own a piece of the development and be up the value chain versus buying retail on the back end in terms of that process. So that's sort of my synopsis on the two. I've done this over 4,000 times. And so I've got enough data. If I look at England, Australia, America, and South Africa, the people that made the best money from over the last 20 years between myself and the investors I assisted were the people that bought existing properties, existing houses and or apartments in any country versus those that bought from new developers. That's my feeling, and I look at some of the new developments I bought in 2005, 2006, 2007, and they were in South Africa, most of them, and I thought I did really well. Like, I'd buy a unit for 450 and sell it for 900, $1 million, and people would be like, wow, you did really, really well there, Scott. And I'm like, no, I didn't. If you do the maths, that property was costing me 2,000 to 3,000 rand a month. By the time the rates and taxes, the rent often doesn't cover the mortgage plus the expenses, etc. It was costing me 2,000 to 4,000 rand a month. Now, if you take 4,000 rand a month and you times that by 12 months, that's 48,000 rand a year. That's 50,000 rand a year. You do 10 years, okay, that's 500,000 rand. So I bought my unit for 450. I sold it for 950. Okay, take off estate agent fees and stuff. And just imagine that didn't even exist. And you could say I made R500,000, capital growth, but it's rubbish because I paid R500,000 over 10 years to own the property. So I'm basically just getting my money back after 10 years. It makes no logical sense if you look at it like that, compared to a property in London, as an example, an existing property I've got where it was a 3-bed, I turned it into 5-bed. It's paid me passive income, positive passive income ever since day one for 20 years. That's a classic example of an existing property versus, buying off plan from a developer. And then, my final concluding thought is it doesn't mean developments are bad. I just would rather, rather than buy from Baldwin Retail, I'd rather partner with Baldwin and actually be part of the development so that I'm up the value chain. And if I'm going to own the asset, I would rather own it up the value chain where I'm doing it commercially. So even if I'm buying residential, I'm buying 100 units versus buying 1 unit, but I'm doing it with others. I'm using smart investing and I'm using technology. And so, ladies and gentlemen, that's all for me in terms of residential versus commercial. Sorry, not residential versus commercial, existing versus developments. And I think I just want to see here if there's any questions. I can see a couple of questions were coming through. It's a good retirement, 3 to 5 years plan. New development need a few years to achieve value. They sold at for a great number of reasons. I've done a vlog on this last week. Yep, Menno, you and I have been in this game a long time. It's not a quick way to get the investment. Take time. Patience is key. 2005 buy-to-let boom created areas like Parklands. I only buy settled residential apartments that were initially sold in a good mix of old, young members. Completely agree with you, Menno. That's what I was trying to say. And whether it's Parklands in Cape Town or some of the areas in the northern suburbs in Johannesburg or Manchester or Leeds or any of these kind of areas where developers build on bulk, around, you've got to be very, very careful if you're buying in investment spots. I 100% agree. Only new development unit I bought was at cost in the development I was involved in exchange for my sales commission. Yeah, and I think that's everything. I see there's 2 questions here. Oh, it was just telling me I'm disconnected. Cool, ladies and gentlemen. Well, I don't know if you've got any questions. I could talk on this for 2 hours from my experience, but I think the overarching experience from my side is that if you're wanting to buy residential property, either an apartment or a house, remember the lesson I gave a couple of weeks ago. There's a big difference between a home and an investment. I'm not talking about a home. This has nothing to do with a home. This is about investment. It's the box that pays you money. And on the assumption that we're focusing on a box that pays you money, I would then go up the value chain. I would make sure that you understand the risks and opportunities of both the development opportunity and the investor opportunity. And most importantly, I'd look at the numbers. You can't get caught up in emotion. It comes down to the numbers. It comes down to the returns and what is getting you the best results. And, tomorrow night, as an example, we've got a diversification masterclass where I'll share with you my own experience. I literally I had a number of properties here in South Africa, residential. I bought most of them from developers. And when I did the maths, they were high in hassle and they were low in return. So high in hassle, low in return. And when I looked at my overseas properties that I had in commercial property, as an example, they were low in hassle and they were high in return. And it's like a no-brainer. And that's not even taking rand devaluation or anything into account. So, high in hassle, low in return, low in hassle, high in return. As an investor, if you take emotion out of it, it should be low in hassle, high in return every day of the week. And I think that's quite important. Yeah, so Dawn, trying to consider the best way forward, don't really like new developments. Look, again, there's a time and a place for everything. So I'm purely talking about return on investment and and actually return on investment and return on time. Because for me in 20 years, I've learned what makes me money. And I've also learned what causes me hassle. And I think the value chain, and that's why I started with the value chain, is so important because depending on where you are in the value chain, will determine your return. And when you're buying a retail development off a developer, you're at the bottom of the value chain. It's that simple. Perfect. Ladies and gentlemen, that's Lunch and Learn for this Wednesday. I will see you next week. Hope you have a wonderful week. Cheers.